What's up guys, welcome back to the channel. In today's lesson, I'll be covering key liquidity areas and institutional order flow. I will use this particular winning trade on this particular chart to convey this idea. This is a very good trade opportunity. I made 4% from this particular trade, and finally price drops to the downside to take the sell side liquidity, which offered about 7% in the markets. By the end of today's lesson, you will improve on your trading performance because you will understand the importance of risk management and the importance of setting a profit target in the market. And I promise you, you're going to have an enhanced market understanding, because when you understand institutional order flow, this helps you understand 50% of what's going on in the market and where you could wait for institutions, because institutional order flow simply explains institutional footprints in the market. Now, this particular trade is just the first example we're going to use to convey this idea, and we have a second setup on Nasdaq. This particular one is on US 30, and you see this is the setup when it was shared. This was when I had my entry, and at this particular point I already made 4% and I was out of the market. As you can see, this is a free Telegram community, so if you have interest in joining this Telegram community, the link is in the description and you can look to join. And you can as well subscribe to the channel. I'm Solomon Wisdom. I talk about smart money concepts. I teach how you can find consistency and be profitable in the financial markets by trading smart money concepts. So if you're interested in concepts like this, you can look to subscribe to the channel and as well support this video by dropping a like on it. Let's jump straight into the content of today's lesson. Now, I said we will be covering liquidity and institutional order flow, and I believe you already understand what these concepts mean in the markets. If you've been following me for a very long time, you understand these concepts, but don't panic if you're just hearing it for the first time, because I will throw more light on these concepts before we jump straight into the main content of today's lesson. Now, institutional order flow involves large transactions impacting the market dynamics. These large transactions influence the market trends, price movements, and liquidity. These activities are carried out by institutional investors, that is the banks and hedge funds. When you adapt to trading the clean flow of the institutions by combining it with key liquidity areas and having set of rules by setting a specific profit targets, this will help you find consistency before the end of this year. Institutional order flow involves large transactions in the market. Now, when you understand where the big banks are transacting in the market, and you know that these transactions impact the market trends and price movements, you see, you are at advantage, and you always take advantage of that in the financial markets. Now, if you're just hearing institutional order flow for the first time, I'm going to use this sketch right here to convey the knowledge so you have a better understanding of institutional order flow. Now, when we talk about institutional order flow, this is caused by a series of mitigation. Now, at this particular point, we see that price reacted massively to the upside. Now, this movement in the market, when we see a momentum push in the market, that is price moving with candles with large bodies, then we have something like this in the market, you should open your eye. Firstly, is a sign of institutional footprints. Now, secondly, when price reverse back to that area for mitigation, not just mitigating but reacting and breaking structure, when you see something like this, this means that institutions had a transaction at this particular level. This particular level I marked right here, where you see price come back at the hash zone for mitigation, then react to the upside. That's an institutional footprint. Transactions has occurred at that particular area. Now you have to pay attention to that area as long as price reacted with large candles to the upside as well as breaking the previous structure. Now, when you have something like this, you just have to wait for price to come back to this particular area and expect another reaction. Why are you doing this? Institutions are transacting at this particular area. Now, what you have to do at this particular point is simply follow their footprints, because definitely there's going to be another retracement and another mitigation, then a continuation to the upside. This is how the institutions transact in the market. This is a textbook example, and you're not going to see it exactly this way in the financial market. But have it in mind that when you see series of mitigation and price is reacting to a specific direction, the institutional order flow at that point is respecting that direction price is moving to. So in this particular example, this is a bullish trend. This means that the institutional order flow at this particular area is bullish. The order flow of the market is bullish. price is bullish. This is just saying like the trend of the market is bullish, but we call it institutional order flow because at this point the institutions are transacting at this area. Now mind you, I say that institutional order flow is just series of mitigation, and mitigation does not really mean it has to be the mitigation of supply and demand levels or order blocks. In this particular case, we have the mitigation of order block, but at this particular point we have a different kind of mitigation. In this particular one, price is mitigating fair value gaps. Price is coming back to rebalance inefficiencies in the market. Now when you see series of mitigations, that is price mitigating imbalances in the market, you see price react to the upside, retraces back to rebalance this fair value gap. If you go to a price chart, you will have a better understanding. But in this case, price rebalances the fair value gap we have right here. We have another reaction and price was able to break the previous high. This means that the order flow is still bullish in this case, because when we had this reaction back into this range, we had the mitigation of a fair value gap once more. That is price rebalancing an inefficiency and a continuation to the upside. So this means that the order flow at this point is bullish as well, because we're having series of mitigation. I'll have it in mind that mitigation is of two types: mitigation of supply and demand levels and the mitigation of fair value gaps. So when you see price reacting this way, have it in mind that the order flow of the market is bullish, and just understand that when price is bearish is just the reverse of this. Let's not just waste much time explaining these concepts. Let's jump to a price chart to convey this knowledge so you have a better understanding. Just like I said, this is US 30 and this is actually on the 30 minutes time frame, and I said I made 4% from trading with these concepts. Now if I try to zoom out a little, you're going to understand what I mean by institutional order flow at this particular area. You can agree with me that the order flow at this particular point was bullish. Price was bullish at this particular area, and after price was bullish for some time, price reversed to the downside and we have a bearish order flow. That means the current flow of the market at this particular area is bearish. But as first, what we had at this particular area was a bullish market before we had that reversal. Now if you try to zoom in to see the order flow of the market, you see that we were having series of mitigation. Price will come back, mitigate an order block, price mitigates an order block at this particular area, and you see that reaction to the upside. And after this mitigation, you see price prints the higher high. We have the retracement where price comes back again to mitigate something at this particular area. But this is not the area I want us to pay attention to. What you will notice is that we had the shift in market structure at this particular point. So at this particular point where price shifted in structure was at this particular area. This was where price reacted and it takes this higher low, then we confirm that we have a shift in structure. But before that, price was able to mitigate this particular level. We have the mitigation of this particular level after price took out internal structure, because price broke internal structure before we had this mitigation, and now we've seen that reaction to the downside. So at this particular point we have price inefficiency right here, but price couldn't get to that inefficiency to rebalance it. Instead it rebalanced this range created level we have right here. We have a range created supply level right here. Price mitigates this supply level and we have that reaction to the downside. A lot of people might actually look to trade from this kind of supply level, but it's not in my rules. I don't trade this kind of level, but it's actually a very good level if you include it in your rules. Now looking at the current price action, what you can see is that price reacted to the downside. But why price reacted to the downside from this particular supply level, price builds liquidity. Let's not forget the concept of liquidity. Now this particular area, we have a range right here where price was building liquidity at this particular area, and if you look right here, this is an efficient range. There is no price inefficiency inside this range. Now when price builds this particular range and you understand what liquidity means in the market, liquidity areas are key areas where we have large pool of money in the market. Now at this point, liquidity was resting at this high. You see price sweeps that liquidity and we have that reaction to the downside, which was able to break structure to the downside. Now at this point, when you see something like this, you should understand that the order flow of the market is bearish. Institutions have stepped into the market, and if you're looking to mark the level you're going to trade from, you see this candle that swept that liquidity. You see this bearish candle. You see how long those bearish candle is. This is your supply level which you're going to trade from. And you see why price was reacting to the downside. Price left some inefficiencies, and you see price came back, rebalanced rebalanced that inefficiency and we had good reaction to the downside. Now if we try to forget about zone refinement and mark the whole zone, this is what our zone is going to look like. And if you're actually the type that considers zone refinement, this is where you could look to refine your level to this particular area. But if I'm to take this particular trade, I'm never going to take this kind of trade because I have to see price inefficiency inside this area before I look to take that. Instead, I will refine my zone this way. I rather include the whole point of interest from here to this particular high, making sure that I have this price inefficiency, which is going to improve the probability of my zone playing out. Why do I like including price inefficiencies? I like including price inefficiencies because once it comes to mitigation, price has to mitigate a fair value gap or a supply and demand level. Now if I mark these particular areas, price might actually mitigate the fair value gap we have right here, possibly tags little inside this particular area and drops. That's why I like refining my zone, so it will be very closer to fair value gap. When price comes back to rebalance the fair value gap, a little touch into my zone will get me involved in the market. So if you decide to refine your zone this way, it's actually a good one. And what else increase the probability of this and making it a high probability trading opportunity? You can clearly agree with me that we have a high right here and this is a liquidity high. If you don't want to mark this inducement area as your high, you see we have relative equal highs at this particular area, and you can agree with me that this is a liquidity area because price ranged a little before we have that drop to the downside. And when we see this kind of range in the market and you see price comes back again, we test that level and we have a little reaction. When you see this in the market, have it in mind that liquidity is resting above this high. A lot of money is resting above this high, and there is need for price to sweep that liquidity. Not only sweeping the liquidity, it has to rebalance the level we have right here for a continuation. Now let's press price forward so we can get to the particular level we had that analysis, so you understand how we made money from that trade. Looking at what you've seen at this particular area, the order flow is bearish because we still have a mitigation of this particular high, and you can agree with me that the order flow is bearish. We have the first mitigation, the second mitigation, and at this point we are anticipating the third mitigation. And looking at this, the order flow is bearish. Playing price forward, you can clearly see how price comes back, sweeps the liquidity above this high, mitigates this level, and we have that massive reaction to the downside. And you see this is actually a very good reaction if you're looking at it on the price charts. Now we're going to look to take another trade from this particular area. Why are we looking to take another trade from here? We are looking to take this trade because we already understand what the institutions are doing. The institutions are moving their money to the downside. Their order flow is bearish. So all you have to do is to follow the clean flow of the institution. Now at this particular point, we have this massive reaction to the downside. What are you going to look for in the market? You have to look out for confluence that is going to make this a high probability trading opportunity. The first thing I was actually looking at when I was having this analysis on Monday morning was this particular area. I made sure I have price inefficiency, and you see immediately I discovered this price inefficiency. I had confidence that this level will actually hold price. What is the second confluence do I have? I see that price breaks structure to the downside, and this is what is very important when it comes to selecting your points of interest. Price broke structure to the downside. Now before price broke structure to the downside, what did price do? Price took this liquidity above this high, and this is another important thing I love seeing in the market. I have my fair value gap, I have the break of structure to the downside, and price took liquidity before it drops to the downside. And remember, the order flow is also bearish. So this is enough confluence to enter the market. Now at this particular point, this is where I marked my point of interest, marking this supply level. And a lot of people will actually ask me, is this another block? Why are you selecting the week? If you drop to a lower time frame, you're going to see why I decided to mark here. Alright, let me show you. Let's drop to the 15 minutes time frame. Now this is the 15 minutes time frame, and you can clearly see why I selected this particular level. If I try to zoom in right now, you can see that we have an order block inside that week. So that was why I selected the week. And if you watch the lesson I released last week, I said it's important to understand the fractal nature of the market, because a lot of people might actually disregard trading from that particular level because they lack the understanding of the fractal nature of the market, understanding price across different time frames. So I talked about top-down analysis on that particular lesson. You can look to check it out after now. Back to the 30 minutes time frame. So here is the 30 minutes time frame, and you can agree with me that we have all the confluence that makes this a high probability trading opportunity. So all I did at this particular point was just share the setup to my free community, even to my VIP community, so people can actually take advantage of this trade opportunity. And I think I shared this particular trade opportunity across all my platforms, even on Instagram. I think I also shared it on Facebook. So if you're looking on my status, you would have seen this trade opportunity. Another thing you have to keep in mind while marking out your trade is have a specific target in the market, because if you are the type that trades the market without a target, I tell you the truth, you might be making very little in the market, because price might actually hit a good level where you should take profit, but because you want more in the market, you might decide to hold and you lose everything. It happens in the market, and I won't like that to happen to you. After watching this particular lesson, create set of rules. Decide how many percent you'll be making in the market. Are you going for 2%, 3%? Are you going for 4%, 5, 6, 7, 8? Choose the percentage you're going to go for in the market. Stick to that. Like always, I go for 4% in the market. Once I make 4%, I either close full position or I lock in my profits to hold. Depends on how promising the trade looks. Okay, now let's press price forward to see. Now price react to the downside, and now we having that reaction to the upside. Now we have a sell side liquidity, and a lot of people who trade smart money concepts, once they get their entry, their target is always this sell side liquidity, that is the external range liquidity. Now price starts reacting to the upside, and I think my profit target was around this particular area. Now price comes back for mitigation, it mitigates our level, and with the momentum price reacted back into our zone, you see a lot of people might be discouraged from trading from this particular zone. Now you see price starts reacting to the downside, and this was a very good reaction to the downside. And if you drop to a lower time frame, this is where you could look to approach this with an entry confirmation. Now price ranged a little, and after the range, what did you see price do? Price sweeps the liquidity above this high, and now we've seen that reaction to the downside. Not just sweeping the liquidity above that high, but price went ahead to rebalance this inefficiency, which confirms that the order flow is still bearish in this case. So this is a very good confluence. You see price builds liquidity, accumulates for some time. Now we have the manipulation where price sweeps the liquidity above this high, not just sweeping the liquidity. Now it mitigates a fair value gap, that is rebalancing this fair value gap we have right here. Now we have this series of mitigation. Now when you see this series of mitigation, this gives you the confidence that this is actually a good trade opportunity to hold. Now let's press price forward to see how price reacts, and you see price comes back again, taps deeper into the fair value gap, and it went ahead to mitigate the zone we have at this particular area. So this is why I said if you approached it with an entry confirmation, you would have still gotten involved in this particular trade. Now price sweeps the liquidity at the high, retraces to the downside, now moves higher, rebalances the lower time frame level, and we have that massive reaction to the downside. And this was the particular low where I made about 4% in the market. I made about 4% from this particular trade, and believe me, if you were holding this particular trade, you would have made more from the financial markets. Now when I saw this particular price action where price mitigates the lower time frame level and react to the downside, I had another trade opportunity, but that particular one was actually shared to my VIP students. Now at this point, I identified here as my liquidity sweep, and you see how price reacts massively to the downside, and you see price was able to break this particular low. So I had another opportunity which I was looking at this particular point. This was another supply level which I had interest on, and I was looking to trade this particular area. I have my fair value gap right here, which I was expecting price to rebalance and possibly mitigate this level. And when I closed my full position right here, this was where I was looking to get involved once more and ride the trend to the downside. Now playing price forward. Now what we see, price comes back to rebalance the inefficiency we have at this particular area, and after that price was not able to get to that level, and you see how price reacts massively to the downside. So this was a little bit painful because I couldn't get involved in this massive drop to the downside. Yes, we have a very good bias, we have all the confluence that explain that price is actually targeting this external range liquidity, but when price fails to get to your level, so you get the second entry and ride the trend, is kind of painful. So I couldn't get involved from this particular level, and you see how price reacts massively to the downside, and this is actually a very good one. But this particular move right here was caused by core CPI. which was released around 1:30 GMT plus 1. That is my particular time zone. Now at this particular area around 3 o'clock, another news event was released, that is crude oil inventories. The news event was released as well. It's an impact news, and you see it was able to push price to the upside. So if you held from here to this particular external range liquidity and where price is currently, you would have made possibly 7 to 8% from this particular trade opportunity. So the second news event that was released pushed price totally to the opposite direction, and have it in mind that since price couldn't mitigate my level and it took out the external range liquidity, I didn't have interest in trading from this particular area again. Price has now taken the external range liquidity, so no interest from this particular area, and the news events was actually able to push price with a lot of momentum, and you see it's blast above this particular high. So currently this is what price is doing. Price has now taken the liquidity above this high. Since price didn't mitigate the level, the liquidity has been taken, and this is the current price action. Now I hope this makes sense to you, understanding the order flow of the market and liquidity areas in the market. Now you understand liquidity areas, you know where you to avoid trading from. And one thing I want you to take away from this lesson is that you should have a specific profit target. And when we started with the lesson, I showed you where I made about 4% in the market, and you see it's a very good one. Let's see the second example on Nasdaq. So this is NAS 100 or 30 minutes time frame, and from what you can clearly see from this particular time frame, we have similar price action. What are we seeing? Institutional order flow, where price was moving to the upside. The order flow of the market at this particular point was bullish. After this bullish order flow, we started seeing a bearish order flow. After we had the shift in structure at this particular area, the order flow of the market shifted bearish and price started dropping to the downside. And if you could remember, about last week or last 2 weeks, I had a trade opportunity which I shared with you guys. I have a trade from this particular level where price mitigates my level and offered me 4% at this particular high, where I took my profit. So I got my entry from this level, took profit at this particular high, and price reversed from there. And remember, we actually had interest in trading from this particular level to ride the order flow to the downside, but unfortunately price couldn't get to the high before it starts dropping to the downside. Now at this particular area, you already understand that the order flow is bearish because we've seen price coming to rebalance inefficiencies. If you agree with me, price came back to rebalance the inefficiency we had at this particular area, mitigating the range created zone right here, and you can see we have a range created supply level right here. And you can agree with me that this looks similar to the particular one we explained, where you see that the institutions are actually dropping to the downside. Now what you have to understand from this particular area is that we have another sweep of liquidity where price comes to take this range right here. Now I've always said it countless times that when you have this kind of range, always expect that there is going to be the sweep, not just sweeping of this liquidity. The sweep doesn't really matter if there is no momentum push away from that particular level. Now once price sweeps a liquidity area and you have price moving with momentum to the opposite direction, that is when you have a trade opportunity. After the sweep and price moves away with momentum, this is when you have a trade opportunity, and it doesn't mean you should jump in and start trading it immediately. No, you have to start looking for other confluence. Now let's look for the confluence that is going to help us, but have it in mind that we already understand that the institutional order flow is bearish. Now that we have a bearish institutional order flow, what confluence do we have? We have a liquidity sweep, we have a break of structure, we have price inefficiency, and we have our order block right here, which we could call our supply level. So this is the whole trading opportunity right here, and you can clearly see that price was able to build an inducement area at this particular point, and this is all you need to see to take a trade. And it's actually very simple to do this, but a lot of people go ahead and complicate it. And have it in mind, once you identify all these confluence you need, you don't always have to win in the market. At some point you might actually lose some trades. And this might actually weigh you down as a trader. But have it in mind that the most important thing is setting good profit targets, and this profit target has to be favorable. So when you win a trade, it has to cover for your losses. This is just what you have to do as a trader, and if you are taking these trades as business. Now this particular point, this was all I got, this was all I needed to take these trades. And when I had this analysis, this was my profit target. This particular low gave me 4% in the market. I was actually very okay taking profits right here, my 4%, because price was building trendline liquidity at this particular area. So having this trendline liquidity, this is a very good liquidity area to target, and we actually have a very good order block if you drop down to the 15 minutes time frame. So this was a very good zone which could possibly hold price. So this was all the trade opportunity. Let me show you what it looks like when I had this analysis. So this was what my analysis looked like when I analyzed the market. You see that particular low right there, that was my profit target, and this offered 4%. It was a very good trade opportunity for me, and I'm glad I made good money from here. Now what you have to do right now is to press price forward and see how price reacts. Now price moves away, sweeps the liquidity above the high, mitigates the level, and we have that massive reaction to the downside. And the thing is that the CPI news was able to help this trade opportunity play out perfectly, and I have other confluence that made me take this. Now at this particular point, price hits, I take profits. Now this is why I said having a particular area you take your profits is actually very necessary in the market. Price reversed to the opposite direction massively. Now imagine maybe you didn't have a profit target, or you were just leaving this trade to take the external range liquidity, and you didn't have the knowledge that there was a news event coming. You would have lost all you made from here. Now another thing I would love you to adapt as a trader is, once you're in profits, try to move your stop loss to break even, okay, in order to protect your trading capital. So this was actually a very good one. These are the two good trades I've won so far this week. You know, I don't take a lot of trade, I take 1 or 2 trades. So the next trades I'm actually in currently, which is making it the 3rd trade I'm taking for the week, is another trade which I shared to that free Telegram community. Let me show you. So it's this particular trade we have right here. This is Euro AUD on the 1 hour time frame. So this is the next setup I'm currently in, and I think I shared it with my VIP students. So this is where I got my entry. At first I would have entered from the level right here, but I waited. When price reached the equilibrium level of the zone, I got my entry from this particular level. You can clearly see price is already in profits, and it was just 15% away from my take profits, and we're having this reversal, and I'm yet to check this particular trade. Let me check it out right now. So this is the trade currently, and from what I can see, price is still playing around at this particular area. Between now and 1:30, what I have to do is just to move my stop loss to break even, because a news event is going to be dropping, I think, unemployment claims. Let's see. So this was actually yesterday's news, where we had the core CPI and the crude oil inventories, which caused the massive movements we're seeing in the markets. Now for today, we equally have another good impact news that is going to be dropping. We have another core CPI and unemployment claim. So these are events that is going to have impact on the market today, and this particular one might have little impact as well. So I hope you got value from what we explained in today's lesson, because all I'm explaining is how you can follow the institutional order flow and key liquidity areas. And if you look at what price is doing right now, you can see that the order flow is bullish, and currently price is reacting from a higher time frame level. We have price reacting there, and from here you can agree with me that we have the same price action, where price comes back to rebalance a fair value gap right here. You see price builds liquidity which was swept, and when the liquidity was swept, what did price do? Price mitigates a very good level right here. This is more like price mitigating a demand level, and we have a sweep of liquidity and a continuation to the downside. Now we have another mitigation. So what I teach is what I trade. Go implement these concepts and you're going to see changes in the market. Now lastly, our mentorship will be kicking off on 15th of this month. So if you have interest in joining our advanced smart money mentorship, all you have to do is check the description. You're going to see a link to test me if you have interest in joining this mentorship, and this mentorship costs $216, and you can look to join this mentorship if you want to find your way to consistency and profitability in the market. So thanks very much for watching today's lesson. See you in the next lesson.